It's not a business cycle, and it's not caused by the free market, overexuberance, or irrational fear by market participants. It is a debt cycle caused by the Federal Reserve, and their manipulation of interest rates is what causes booms and makes the following busts inevitable. In order to understand what's going on here, we have to talk about how money works first in a free market. The easiest way to visualize what is going on here is to imagine a desert island with a closed economy where they use gold coins as money. There's a limited supply, and if you want to get more money, you have to provide a product or a service to other people who will want that product or service so much that they're willing to give up some of their money for it. In other words, there is no player who has the ability to just arbitrarily create more money for themselves, giving themselves purchasing power that other people don't have. In a free market economy like this, sometimes the savings pool will be full. In other words, people have lots of savings because they haven't been spending, they haven't been investing, and they haven't been borrowing. They've simply been working and putting money away. In an environment like this, if I went out to the market with some of my money and tried to loan it to somebody, because here the savings pool is full. Everybody has been doing the same thing as me, so there's really no demand for the money. Everybody has money for themselves. That means if I want to entice somebody to borrow from me, I will have to offer them a very low interest rate. In other words, in a free economy, when the savings pool is full, it naturally pushes interest rates down because money is abundant relative to goods and services. You can see how low interest rates in this environment would be a signal to somebody that they should start spending and they should start borrowing and they should start investing. In an environment like this, people would naturally understand everybody's got a lot of money. And so if I borrow a little bit of money at a very, very low interest rate and use that for productive purposes, then I can make a return that is way larger than the amount that I'm going to have to pay on the debt. And so a large savings pool will naturally incentivize spending, borrowing, and investing. And it does this through the interest rates being naturally pushed down. That is a signal sent to economic participants that it's time to spend and grow. But if this process goes on for too long, you can see how the savings pool would start to dwindle. Everybody starts to borrow, everybody turns into borrowers. There would be very few people left with savings to lend out. In that situation, the person with the savings will be able to demand a much higher interest rate because everybody is a borrower and a spender, so they're all competing for the little bit of savings that is left. This means there is now a profit opportunity just to have money because you get to be the lender. In other words, the high interest rates, which are caused by the scarcity of the money supply, the low savings pool, are a natural incentive to start saving again and to stop spending and to rebuild that savings pool. In this system, interest rates would ebb and flow, would constantly be changing, obviously depending on the borrower, the project, what the money's being spent on, but it would keep a natural equilibrium between the supply and the demand for money and would make sure that there weren't any booms and busts. Because as the savings pool dwindles down, the incentive to save grows at an equal pace. But this is not the system we live in today. We do not have a free market, and especially not with interest rates. Hey, and real quick, just in case you missed it, this last Thursday, I hosted a free masterclass live on Zoom. On the call, I detailed something I call the asymmetric trade. This is a strategy that can help you profit from chaotic events, and it's a strategy I have personally used to take home returns as high as 279%, 733%, and even 1,299% in a matter of months. And even though 1,000% plus gains are generally the exception and are not the rule, with everything that's going on right now, from the trade wars to the volatility in crypto and stock markets, to even the potential for World War III, I believe these trades will be the key to both growing and protecting your wealth in 2025. If that sounds like something you're interested in learning about, make sure you check out the replay. It's linked in the description below. Today, the Federal Reserve does not outright control all interest rates, but they do control the federal funds rate, and that has a large influence on other interest rates. And the Federal Reserve changes interest rates for the explicit purpose of manipulating the economy. They will lower interest rates in order to stimulate economic activity and growth. In other words, they are trying to send the signal to the economy that the savings pool is large, which will encourage and incentivize people to borrow and spend and invest. That is the purpose. That is why they lower interest rates. And the very fact that they have to be the ones to push interest rates down mean that they are lowering interest rates below what the natural interest rate would be without their interference. Meaning the signal that the Fed is trying to send to the economy is an incorrect signal. They are trying to cause spending and borrowing to happen that would not happen otherwise, meaning it's a misallocation of resources and it's malinvestment. This causes booms, which is prices going up to levels that they shouldn't be because the spending is at higher levels than it should be given the money supply. The flip side is true as well. When the Federal Reserve raises interest rates, they are trying to send a signal to economic actors to stop spending, to start saving, to not invest. Now, usually they will raise interest rates when they have concerns that inflation is getting out of control, which makes sense because what they did before was cause the inflation. And so they are raising interest rates in order to try and pull back spending and encourage saving. The only problem is they're doing this from a level at which valuations and prices were already way too high, which means by them trying to slow the spending, they are triggering the bust. And as spending, borrowing, and investing grind to a halt as a result of it being way more expensive and the signal being sent to economic actors to stop that because the savings pool is depleted, we're doing that from a point of artificially inflated prices. This reverses the wealth effect and causes asset prices to collapse. And this is the boom bust cycle. This is not a debt cycle that would occur naturally outside of central planning and government intervention. This is not the result of people just being greedy, being fearful, free market participants just being irrational. The boom bust cycle is a direct result of government or central bank control over interest rates. These are false signals getting sent out to economic actors like you and I and other businesses and individuals trying to incentivize us to do something that we would not do otherwise. Now, this doesn't mean that there is no hope and that you cannot make money through these cycles. In fact, you can make a lot of money on the way up and you can make a lot of money on the way down. One of the keys, though, is finding a portfolio of quality stocks that have stood the test of time. And this is exactly what I've done with my Century portfolio. It is completely free, but I have put together what I call my 100-year portfolio. These are stocks that have stood the test of time and are poised to generate very good returns for decades. These are stocks that have survived booms and busts, and they thrive through it as well, sometimes even absorbing assets from other companies that go bankrupt during these boom and bust cycles. If you're interested in this portfolio, number one, it's completely free. You get all of the stock names, the ticker symbols, everything like that. The allocations, I even published a course for you that goes through the exact stock selection criteria so that you can learn how to do this if you want to do it for yourself. Even give you a way to follow along automatically with the portfolio for any updates. And again, it's completely free, not even a sales pitch attached to it. If you're interested in following along with my 100-year stocks, my Century portfolio, click the link in the description below. As always, thank you so much for watching. Have a great day.